Welcome to Multifamily Method, a podcast which explores the state of the multifamily real estate market and some of the backgrounds, methodologies, and words of wisdom from some of today's most successful multifamily real estate entrepreneurs nationwide.
I think that the market rate, conventional owners and operators, they've got to do a better job too of being cheerleaders for affordable housing, because number one, it's the right thing to do. But number two, it's going to take heat and pressure off the market rate space, which is being cast and viewed as something that it's not. The market rate space is catering to higher income renters. But there's things we can do to support affordable housing that would, again, take care of renters, but also to remove some of that misguided heat on the market rate side.
Well, today we're honored to have Jay Parsons as a guest on Multifamily Method. Jay is currently a vice president at RealPage Incorporated and serves as the head of economics and industry principles. Jay's a rental housing economist and real estate SAAS executive for over a decade, working across market research and forecasting, revenue management, leasing, business intelligence, and risk management. Jay's an author and speaker on topics including rental housing investment and asset management strategy, rental housing policy issues, risk management and property management covering apartments and single-family rentals. Jay's been cited in the Wall Street Journal, my favorite newspaper, Bloomberg and CNBC, among many other outlets. Commentaries published by the Pension Real Estate Association, the Mortgage Bankers Association, the National Apartment Association, American Banker, and GlobeSt. Welcome, Jay. It's great to have you on the podcast today.
Thank you, and thanks for having me.
Absolutely. Well, let's dive right in with a little bit on your background. How did you first get interested in economics specific to the rental housing industry?
Well, I kind of stumbled into it. Going back, I started in 2009, the beginning of the last recession. And kind of funny story. It's 2009, I needed a job. I was getting engaged and feel like I needed to be kind of productive. And so took a job I thought would be kind of a temporary job just to kind of get through that period of time. And that job was writing market research reports on the apartment industry. And it was pretty dry, but kind of fell in love with the industry and thankfully got some good opportunities. And so again, kind of stumbled into it like a lot of people in the industry have, but very thankful in hindsight that I did.
Yeah. That's so interesting. I'm curious what made you fall in love, because personally, for me, Jay, I had a medical sales background and then just fell in love with commercial real estate 7 years ago or so and just got the bug and haven't left it since. I'm wondering what grabbed you.
One thing I love about particularly rental housing and apartments is that it's something that everybody thinks they understand, but really do not. There's a lot of myths, conventional wisdoms, both among the general public, among investors, among policymakers and media, and so that makes it a lot of fun, is to try to educate. As I've had the opportunity to really dive into the industry, I've learned some things over the years that have surprised me, and so it's fun and rewarding to kind of play the mythbuster role and kind of help explain what apartments really are and who lives in apartments and why they make sense and why some of the policy narratives are wrong and just the general perceptions are wrong, whether it's about apartments being developed in a neighborhood and the NIMBYist reaction to that and all the myths you hear at city council meetings, or it's about the myths around affordability and rent control, or the rent versus own stuff, how people really make those decisions, and how we underwrite them. I mean, there's all sorts of stuff. I go down the list. There's a lot of kind of conventional wisdoms about renters and rental properties that I think are, I don't even say outdated. I think they're just frankly wrong. So I think it's rewarding, but I think it's also important because we need rental housing, and it's an important cause where a lot of these myths get in the way from what's really a public need.
Yeah, that's a great point. And I like that term, mythbuster. So we'll try to overturn the apple cart today and recognize that a significant minority of Americans do live in rental housing, and really peel back that onion. And to your point, the narrative is these quick talking points oftentimes in the media, but being quick and witty isn't always the same as being right. And sometimes it takes a little more insight and a little more depth to dive into the statistics to see what's really going on, which is why we have you here today. I've always loved your online publications. I follow you on LinkedIn. You're always putting out content that makes me think and re-examine even what I know every day. So thrilled to have you as a guest. So
I appreciate it.
Let's start with some of the trends you're seeing in rent growth. Rent growth has certainly been on a tear in the last 18 months or so. So I'd really be curious what you're seeing across the country, and then maybe we could break it down a little by A, B, and C asset class to better understand what's going on in the subtypes.
Sure. So, we're still seeing a lot of rent growth. There's different ways to measure rent growth, as you know. The one that I really like to look at most closely is the trade out, which is, lease over lease, what someone paid versus the previous occupant of a unit. And we're still seeing the new lease trade out is still going up. We're in the upper teens right now through June. And on the renewal trade out, what someone pays to stay in place in the apartment side, we're close to 10%. And we're seeing very similar trends from the big single family rental operators. And so bottom line is there's still more demand than supply. That's pushing up pricing. I think that, going back to beginning of the year, there are a lot of forecasters who forecasted this massive reversion of the mean this year. I think that was always a misguided view. Now, that said, I do think we're kind of at a pivot point here, which we could talk about more in a minute. But I think a lot of what's happening right now through the first half of the year is we're seeing, the big run up in rents really started last spring and summer. And so it's that first kind of that first group of leases as they turn, we're seeing a lot of big correction. We're upwards. And as we go forward, as those leases start to turn a second time, I think we're going to see, more moderated rent growth. So still a lot of rent growth right now across all asset classes, A, B, and C, mostly A and B, where we see the most growth. And A, it's been the most volatile. It's all the most. It's really the only segment that saw cuts in 2020. And then Class C has been stable, but just doesn't see the same kind of upside. And the real sweet spot has been B. It did not see any kind of real downside like A in 2020, and it's performed really well. I think a lot of that is B is very well positioned. B and C oftentimes get lumped together, and it always drives me nuts when I see people combine B and C into one trend, because in B, you don't have the affordability concerns of Class C, but you don't have the supply pressures of Class A because the rent gap is just so significant between A and B. And it's really been that way since the great financial crisis. So I think B is really well positioned going forward as well.
Yeah, it's interesting you say that, Jay. Obviously, on the investment sales side at Capstone, we close hundreds of deals, about 500 this year, with investment groups. And there are some who have really honed in on the B asset class as a very safe play right now. And it seems you're validating that investment thesis a little bit.
Oh, yeah. Yeah, I think, again, going back to Mythbusters, it's not just the public, it's also investors. And, one of the terms I absolutely hate is the so-called flight to quality. And it's this idea that in a downturn, everybody in a Class B unit and everybody in a suburb is going to move to the urban Class A, kind of glossy high rise for the, deep concession. That's not really true. And it doesn't really happen in real life. And one of the reasons for that is that, in these brand new, anything brand new, saying like the last 5 years or so that's been built, you'd have to offer 6 months concession in order to bring somebody out of kind of your typical Class B unit. And so they're very insulated on rents. And I say Class B, it's really Class B to A minus. I mean, even the A minus stuff that was built 10 plus years ago is really well positioned relative to today's new supply. So yeah, I'm very bullish on that. Low rent income ratios, but much more affordable than A plus stuff being built today.
Okay. That's great insight. Thank you. What are some of the strongest markets for rent growth right now? What are you seeing?
Yeah, it's moving around a little bit. Early on, everyone was talking about the desert, Phoenix and Vegas, and then, places like Riverside, and then also Florida. all over Florida, Tampa, Orlando, South Florida, even the tertiary markets, the beach markets like the Space Coast, Sarasota, Bradenton, Fort Myers, Naples, all these kind of places. And it's changed a little bit, I was on the other side of this a year ago. I was always reminding people, hey, I think these are still pretty volatile markets. And you're seeing that in the upside. And if we have when we do have a downside, I think we'll see it a little bit there as well. Now, those markets, I wouldn't say are cooling off, but they've moderated. They're closer to the national average right now. And so where we see a lot of the biggest growth at the moment, it's kind of a hodgepodge of markets. We see places like New York, which got really deep cuts and it's just kind of bounced back. We have some of the Texas markets, the Southeast, some of the places. We've also seen some improved numbers in some of the other gateway markets like a Seattle that had bigger cuts. So it's a little bit of a kind of a mix of markets, but we don't really see the severe outliers anymore, like the Phoenixes and Tampas that were 30+%. Where there's a much narrower spread now in the rent growth numbers by market.
Interesting. Okay. And are there any particular markets that you think investors should have any concerns about or see just a ton of upside in that you'd give advice to investment groups who are listening to this?
Yeah, no, I think I think obviously it's always specific to the deal, but I would just still be careful about the markets that I mentioned earlier. I think particularly Phoenix has seen. It's always interesting. I always hesitate to it's hard to couch this because I don't want to come across like I'm anti-Phoenix or anti-Florida. I'm not a naysayer on those markets, but I think you have to be careful. We've seen a lot of capital migrate from California into Phoenix, among other places. Mm-hmm. And I think when, you start to see cap rates that are lower in Phoenix than they are in, a Dallas or a Denver, that doesn't really make a lot of sense to me structurally. I don't think Phoenix is a better market than those markets. And so I think it's just looking for the relative opportunity and kind of the timing of it as well. I think just, applying some common sense in that measure. Now on the upside, I'm still of the view that, a couple things. I think that while it's gotten pricier, your bread and butter Sunbelt kind of class B to A minus, and even new construction I mentioned earlier in places like Texas, the Carolinas, Nashville, it's obviously gotten more expensive. But I'm of the view that this is a long-term play. These are not opportunistic markets anymore. I believe these are the new core, and the Southeast, South, and some of the Southwest up to Denver and Salt Lake City. I think these are the new core markets that have performed not only better on the upside, but have also been much more stable since the great financial crisis, and obviously have very favorable demand drivers, demographics, economies. They're attractive even now in the work from home phase. So I see those as still having, for a longer term investor, being attractive. And then also too, I would say that that typically as you kind of get further into a cycle, you start to avoid tertiary markets or start to, the mindset tends to be that those are more risky. But I think COVID and work from home have changed that dynamic a little bit. You still have, if you could still find an attractive cap rate in or attractive deal in some of these, destination beach markets to work from home, particularly, just places like Savannah and Wilmington, North Carolina, or even the mountain places like a Provo and an Asheville. And I'll go on down the list, but I think if you can find, I think those are places that have structurally become more attractive and are still relatively early on in their kind of investment cycles. So everything's more expensive. I think that's the tough thing. Everyone's like, oh, it's gotten so expensive here or there. I was like, oh, it's true everywhere. And it's true for everything, not just apartments. And so it's really about relative positioning. And I think that's the challenge to bear in mind as you look at deals right now.
Yeah, you make a very interesting point. I think with the Zoom world that we're living in now and the ability to work remotely from anywhere, we're going to see these tertiary markets stay strong for maybe longer than we've ever seen historically, because people would flock back to the major metro employment centers. And maybe that mean is now gone. I guess time will tell. That's a very interesting point. So what are you predicting in terms of rent growth for the second half of the year? So you said the first half of the year was very robust, in low double digits. And what are you thinking the second half of the year?
Yeah, no, we're north of 15% right now. For the rest of the year, we're projecting we finish the year around 10%. And so I think we're going to see some moderating monthly rent growth going forward. It's interesting, going into the year, I think we all kind of expected things would moderate a bit, but we didn't know exactly why. And some people would say affordability and other things like that. But, what really ended up happening, obviously, is I think the trends in inflation have kind of given us clarity on why things are slowing down. So we really haven't changed our forecast too much. We're still forecasting around 10% for the year. And, a lot of that for a couple of things. Number one is we're at such a strong point right now. And number two, that, rental housing is uniquely positioned to kind of, you hear the expression that, rental housing in particular and real estate in general is a hedge against inflation. And one reason for that, as is that with rental housing, you have typically, leases around a 1-year period. So you're able to, kind of correct for inflation fairly quickly. And so as long as inflation persists, which I think most of us at this point believe will be, even if we peaked, you could debate all that, but there's still going to be, I think we'll still see expense appreciation through the rest of the year and pretty much everything. And as long as that continues, I think we'll continue to see sizable rent growth above normal, just because the costs are going up. Property taxes, as are through the roof. Utilities, payroll, insurance. All of these things are going up. And so I think we're going to see is that profit margins are going to thin out a little bit, but we're still going to be able to see pretty sizable rent growth as operators push to, offset these expense increases.
Yeah, so what you're describing is a fairly stable to maybe somewhat positive NOI as the OpEx grows, but the revenue grows as well. Is that a fair synopsis of what I heard?
Absolutely. I don't think we're going into the red, to be clear. But I think we're going to see the unprecedented rent growth numbers. I don't like the word cool off or slow down. I think it's a moderation. That's the term that I prefer. I think we're going to see some moderation where the rent growth numbers are closer to headline CPI, and that, but not all the way there for most of the market, and that expenses go up. But as there's a lot of expense mitigation efforts going on right now too. So I think NOI will still be healthy, but just closer to normal as opposed to the weird volatility of the last couple of years. 2020 was tough, obviously. 2021, obviously was a much more positive story. And I think by the end of 2022, it'll be, amidst all the noise, it'll feel if you're just looking at a financial sheet at the end of the year, I think it'll just look a little more normal than it has the last couple of years. How about that?
Yeah, there we go. Well, it's funny to me how as human beings, we have recency bias in everything, right? And people say, woe is me, my OpEx is going up. But they sometimes forget to look at that we're having this historic rent growth when 3 to 4% a year was great. And now they're getting 10% coupon clips up. And that really, you got to look at that holistic picture, not just bemoan rising interest rates and operating expenses. You got to look at it, I think, in the context of which it's happening. And you can't expect that last year you were in Atlanta and you had a 20% rent growth, that's going to continue forever. People don't have an unlimited income to throw into rents. Trees don't grow to the moon, as my dad used to tell me. Everything stops somewhere. So that really is a good.
No, yeah, you're right. And I've been trying to tell people too is, I think regardless if you've been in the industry for 1 year or 50 years, I think when all of us retire, here's one forecast that I feel fairly confident about. I think when all of us retire, we'll never have seen again a period like 2021, early 2022, and that type of rent growth. Anything could happen, obviously, but odds are it hasn't happened in 40 plus years, and it probably won't happen again for 40 plus years. So I think recency bias is a big thing. Yeah, you can't think of that as the baseline.
There you go. Well, this transitions beautifully into the next conversation I had with you, and you have a ton of insight on this topic, Jay. I'd really love your perspective. So the media really struggles when they're describing affordability and rents, differentiating between asking rents and in-place rents. So can you help us set the record straight on what true rents really are and what the story is out there?
Yeah, well, I guess, first and foremost, I think the industry has this awkward relationship with internet listing sites that advertise rentals because it's part of the marketing engine. But I think a lot of them do a disservice to the industry overall by blasting out media releases showing rent growth numbers that are entirely based on advertised rates, but are not reflective of reality. And so what's happening is that, vacancy right now is, 3%, something like that. And so when you see, obviously, this, when you see rents that are advertised online, it's representing the 3% of units that are available, I guess with future exposure, let's call it 5% generously of units that are going to be available in the next 60 days, 60, 90 days. And that's not reflective of what people actually pay. Because again, most people's gauge, policymakers, media, and even a lot of investors, their gauge on the market is based on what's happening in that 3 to 5% of units at any given time. That's not a comprehensive view of the market. That's only of this sliver that's available at any given time. And so you have to take a more comprehensive view, which is looking at not just the new lease advertised rate. You have to look at the trade out for what's actually being signed. And then, which by the way, does not even reflect asking rents either, because as you know, one of the things happening now is when you go to rent an apartment, especially, it's not just a number. You're given a matrix of pricing options based, hey, if you move in this date, move out this date, that's your rent. And a lot of times, renters are picking the cheapest option. So it may actually be, a longer term lease, for example, with a quicker move-in date that is, a longer commitment that in exchange the operator is offering a lower rent. In fact, I'll give you a quick funny anecdote here. I saw there was somebody trended on Twitter with a comment about how they were trying to lease an apartment in New York in Chelsea, which is, and you probably know, one of the most expensive and exclusive neighborhoods in the country. And she was just aghast at the fact that if she moved in immediately, her rent would be, I think it was like, let's call it $9,000 a month. It's obvious, it's Chelsea, very expensive area. If she moved in next month, it was like $9,500, and she couldn't understand why that difference was in place. And obviously the reality is that, there's a vacancy loss factor. And if someone's not moving in for a month, you're taking $0 in revenue for that. And so operators, they incentivize renters to make a choice that is ultimately kind of mutually beneficial here. Mm-hmm. And so that's part of it as well, is these advertised rates do not reflect people actually pay. And the second part of it, it also doesn't reflect the renewals. Renewals have been growing at half the rate of new leases. And so, are rents still growing a lot? Absolutely. Rent rolls are up 10%. I don't want to downplay that as insignificant. It's a lot, but it's not 20%. It's not 18% like you see on headline asking rents. And so it's really important to, take the full context of what's happening with rents and not just what, some internet listing site is advertising to generate media attention about their website.
Yeah, that's a great point. And with the renewals, certainly the operator is incentivized to keep that occupancy stable, keep that renter in place. They've been a good renter, presumably at that point. So there's benefits there as well. Absolutely.
Absolutely. Yeah. Renewals are part of it. And, but also one last comment on that too, is that when you see like the CPI trends, rents are up X amount. It's position. People have to remember that rents are not like the cost of gas or food. Your prices don't change month to month. For the vast majority of renters, your rent is locked in from the time you signed a contract, which could have been 9 to 10 months ago at a much lower rate. And so the in-place rent roll is what reflects what people actually pay, and the growth in that, which is going to be much slower increases than just the asking rent.
Yeah, that's a good point. It does beg the question in my mind. You talked about either moving in immediately or extending the length of the lease. Are you seeing any trends where we're seeing, for example, longer leases so that tenants can have a little bit more affordability in their rents? Have you seen anything like that on a national level?
Yeah, it's interesting. Early on, we saw this go the opposite way, where in 2020, there's a lot of uncertainty. And so we saw a lot of, month-to-month extensions during the lockdowns. We saw shorter-term renewal periods, especially. And people are just trying to figure out, what they're going to do. They just need a little bit of time. And so shorter terms. What we're seeing over the last, call it 6-12 months is more of, I think we're more of a reversion back to more normal. A typical new lease is like 11 and a half months. A typical renewal is a little bit less than that. And so we're just seeing more kind of reverting back to normal. And I think as rents continue to increase, we'll probably continue to see that, where renters are generally going to take that, especially with a lack of availability right now, a 14, 15 month lease Not that that's going to become the average, but just saying, I think more and more renters will see that option as attractive, given the uncertain outlook in the economy and given the better price point that they're going to get for that commitment usually.
Absolutely. Lock down your costs as long as possible, AKA Southwest Airlines and fuel futures back in the day, right?
Yeah.
Okay.
Yes.
Interesting. Now, what are you seeing on the concessions front? Are we seeing more concessions or less? I'd be curious what trends are along those lines.
We really don't see any concessions. I say any. We don't see very many, single-digit percentages. And where we do see it, it tends to be in the Class A plus stuff. Obviously, it's still fairly common in lease-ups. And particularly in kind of urban, and I say urban, not just like the New Yorks, but also even like, downtown Sunbelt markets, there's been a lot of construction. Those are places where we still see some concessions. But, in general, even in 2020, when things were uncertain, we never saw concessions really skyrocket like they did in 2009. And part of it's because obviously availability is so low, but also too is, as I'm sure concessions has become a very controversial topic among asset managers in the industry. And so there's a growing number who will no longer offer any concession and instead favoring kind of effective pricing. So I think for those combination of reasons, we just aren't seeing a lot of it right now. Okay.
Very good. So let's segue over to another topic that you've touched on a little bit, but I'd like to explore in a little more detail. And that's affordability. And that is such a buzzword right now. We just touched the lightning rod, forgive me. And I'd love to get your thoughts on it because the media has certainly made this a rallying cry. You see protests in the streets of some markets about rent and affordability. And what's the real story here, Jay? How are we to understand this complex issue?
Yeah, so as you mentioned, it's a topic that is near and dear to my heart, and one where I think is misunderstood. I think one of the big mistakes people make, particularly outside the industry, is they look at rental housing as one homogeneous thing. And so because of that, they take a view that everybody who lives in rentals is living in a rental by necessity because they cannot afford to buy.
Right.
And that could not be further from the truth. And so it starts with kind of with sort of a looking down upon renters as these people who are an inferior class and, they can't afford to buy. In the meantime, they're, we don't, it's just, it leads to these, once you have that mindset, that's what stirs the stuff about, trying to limit number of rentals in an area, trying to stop apartment construction, HOA is trying to block renters moving in because it starts with that view that renters are an inferior class. And again, that couldn't be further from the truth. And so, number one, renters rent for a wide variety of reasons. And number two, when you look at the rental housing market, you have to split between two different things. One is the market rate sector, which is what we track most closely. And two is the affordable housing space, which is an entirely different space. And you do not see a lot of crossover between these two sectors. Mm-hmm. And so when you look at, for example, affordability trends, whenever you see a headline about people paying 40, 50% of income on rent, that's absolute garbage. And there's no property manager in the country that's going to lease to somebody spending half their income on rent. Like that's not going to happen. Even the mom and pop space, they all look at that. Your level of sophistication and screening can vary dramatically, but everybody looks at rent income. Mm-hmm. And so you're not going to see those kind of numbers unless you're in the affordable housing space, in which case your rent is capped based on the incomes in the area or the incomes of the resident. And so, it's a little bit different scenario. Now, so kind of two thoughts here. When you separate these two sectors, on the market rate side, we've seen income skyrocket, and I could go into that for a long time here, but there are a lot of reasons for that. So rent income ratio has been very steady, 22, 23%. That's not alarmist at all. No. On the other side of things, the real challenge is a severe shortage of affordable housing. And so what's happening is the lack of affordable housing options is putting pressure on the market rate space because people don't have anywhere to go. You're on some places a 10-year wait list for true affordable housing, and you're trying to find a place that's affordable but actually market rate, and that becomes the source of your angst, is that is not available. Mm-hmm. And so we've got to fix that problem. We got to have more public support for affordable housing. And frankly, too, just one last comment here, because I know I could go on this forever, is I think that the market rate, conventional owners and operators, they've got to do a better job too of being cheerleaders for affordable housing, because number one, it's the right thing to do. But number two, it's going to take heat and pressure off the market rate space, which is being cast and viewed as something that it's not. The market rate space is catering to higher income renters. But there's things we can do to support affordable housing that would, again, take care of renters, but also to remove some of that misguided heat on the market rate side.
Okay. Yeah, well, let's dive into that a little bit more. So are there any pain points that could be solved? It's primarily a supply issue on the affordability side. I 100% agree with you. Are there any pain points that could be solved with a public-private partnership, government intervention?
Yeah.
Like how do we claw out of this hole is the question.
Yeah, absolutely. So, it's interesting. Whenever I post in this comment online, there's always people who kind of come in two different camps. One is is kind of one extreme is hey, we need, government to take over housing. And they kind of forget that the government has an absolutely horrendous record of property management and development. They're terrible at this. Mm-hmm. When you look at, it's ironic to me is you see all the conversation the last couple of years about evictions. It's like, all the institutional owners are evicting people. Well, that's not actually true. There was a book written a number of years ago called Evicted, and it shows that the vast majority of evictions were coming in public housing, and a lot of these facilities were very poorly managed, very poorly maintained, and they have tremendously long wait lists, have been just incredibly poorly managed. Like, that's not a model to follow at all. Mm-hmm. On the flip side, you have those who say, hey, the private market should take care of all this and they should fix it. Well, the problem is that you can't build affordable housing without taking a huge haircut. It just doesn't work. It does not pencil out. Mm-hmm. And I think, what's happening is that what's being built today is very expensive because of land costs, because of regulatory costs, because of acquisition costs, because of construction and labor and materials, and on down the list. Everything is super expensive. That drives up the rent. And so you mentioned public-private partnership. The good news is there are programs that work. They're very fragmented and underfunded. But you look at, there's HUD programs, low-income housing tax credit programs. There's all sorts of programs that can work. The problem is just there's too much red tape and they're too underfunded. But these types of programs, what happens is, is that, the government providing in various, they can be incredibly complex, unfortunately, but it really boils down to the government providing some sort of subsidy to the private sector. In exchange for the private sector renting units that are capped on rent at an affordable level. That can be it has been a tremendously successful model. Again, there's just not enough. That's the biggest problem.
Multifamily Method is powered by Capstone Companies, the largest privately owned multifamily investment sales brokerage nationwide. Capstone Companies provides dedicated coverage to both primary and secondary markets throughout the Southeast, Mid-Atlantic, and Midwest regions of the United States. Whether buying, selling, or refinancing, Capstone Companies is here to help. Simply put, Capstone is expertise, experience, extra mile. If you're interested in having Capstone provide a complimentary opinion of value on your multifamily asset, please visit us at capstone-companies.com.
What are you seeing in terms of income versus rent, the trends? You said 22% was the actual number. So all this hoopla we hear in the media about people being above 30% of their income, which is the classic definition of affordability, you said is pretty much a myth. So what are you seeing in terms of the income piece overall across the board?
Yeah, so we're nationally right around 22-23% range. It's a little bit higher in Class C. We're dealing with typically it's more the kind of naturally occurring workforce housing. The rent income ratios could be 25-26%, but still below 30%. It's lower in Class A, even though the rents are higher, the incomes are also much higher. So what's happened is that, so just to give you a little bit of context, we're tracking incomes from lease applications, people who ultimately sign a lease. And what we've seen is that, going back to prior to COVID, beginning of 2020, Rents for new lease signers have gone up about 22%. And the new lease rents, again, just what new lease signers are signing, so apples to apples, is also up about, it's up about 0.5 percentage points higher, 50 bips. So it's not much. It's basically the same. And so that's kept rent income ratios relatively stable. And so today, a typical market rate apartment household signing a new lease is, and this is household, so roommates, is around $75,000 in income nationally. And that number always surprises people. But again, it goes back to the myths of who lives in market rate rentals. And just real quickly, I think a lot of this is, you look at the typical apartment profile, these are people who tend to be right around early 30s age group on average. They typically have roommates. And when you look at this demographic, I believe that they've economically fared much better than the overall population, in part because, you look at the Fed data, it shows that, or BLS data, a lot of the biggest growth is among younger adults. Mm-hmm. You look at all the hiring that's occurring, as the millennials and Zers get older. When you're trying to fill jobs, a lot of these openings are for, kind of entry level, stage 2, kind of mid-level roles. And that's where a lot of the competition is, the most competition. So this group, is seeing, I think, significant wage growth, particularly when they change jobs, mm-hmm. and on a percentage basis. And so that's all contributing to the numbers that we're seeing. It's been, I think, again, I want to be mindful. It's not everybody seeing this, obviously, but there's a good segment of the population that's seen very sizable income growth.
Yeah, a couple of things there. I think you said one is that data really validates that commercial real estate, and in particular housing, is a hedge against inflation because the income tracked right along with the rents, right? Almost real time. Yeah. Based on the data, the 25 to 50 bip swing is inconsequential in the grand scheme of things. And I think the second thing you're really hitting that I very much agree with, especially with millennials and Gen Z, is that there's a ton of renters by choice, Jay. These people want to rent. They want to be mobile. They want to check out a new town every few years and have new experiences. And that's just part of the life they've chosen. Yep. Some of them are delaying marriage and kids to a little bit later, which makes you a little bit stickier, right? You need the yard and the dog at that point, and you don't move as fast. Yeah. I do think there's some significant cultural pieces at play too here, not just financial, that absolutely factor into this.
Oh, 100% agree. And on that, a lot of the focus is always on the fact, kind of that we call, prolonged adolescence or late adulthood, people getting married later, having kids later, obviously that's a factor. But I also think there's a little bit of a, if you build it, they will come phenomenon that's happened here. If you think back to 20 plus years ago, rental housing was a generally inferior housing. Typically they're kind of in, back corner locations, and it was sort of very basic, housing. In the last couple of decades, that's really changed, particularly in apartments. We've seen very nice, the word even luxury apartment development has been kind of commoditized a little bit. Everything's luxury now. It used to be, 20 years ago, if you had granite countertops, that was like top of the market. Like that was the thing. Everything has granite countertops. And so the fact that we now have very desirable locations, very desirable places to live, that's really changed the equation in my mind. I don't think that factor gets enough attention. Apartments in particular are not just about places that you have to live in. They're places that you want to live in some cases. And again, not all cases, but then also the build to rent single family trend has, I think, extended that a little bit, giving people an option. If you want to have a single family home, but enjoy a rental community and having somebody take care of all your stuff, that's an option. And also the professionalization of the single family rental, the scattered site side. It used to be, kind of the just Craigslist and listings on newspapers and yard signs. The professionalization of that sector has really changed the equation as well, and made it, I think, a more viable option for a lot of people. So, I think there's a number of factors, to your point, the demographic side, but also I think the industry has kind of caught up to some of these trends by providing better options that in turn, extend the life stage of people living in rentals.
That's a really good point as well. Excellent. Okay, let's make you predict the future, but not hold you to it. This
Thank
is the
you.
job of every economist to just put something bold out there and then get judged harshly or favorably 6 months after the fact, right?
Right.
What do you predict in terms of rising interest rates and how it will impact cap rates and values through the rest of 2022?
All right, so I'm glad you said rest of 22, not like 5 years out. In terms of interest rates, I'll tell you. I mean, you look at the history of economists and forecasting interest rates; it's pretty horrible. The Wall Street Journal tracks consensus forecast versus actuals, yep. And it's funny because people have been worrying about interest rate risk for as long as I've been in the industry, since 2009, and it's never been a factor until now, right? And so, I'll give you my view on it with that caveat that I'm probably going to be wrong. Is that I think we'll probably see inflation's kind of peak and start to moderate a little bit, but I still think it'll be significant compared to kind of history and what's normal for people who've only been in the workforce for the last 10, 20, 30 years and weren't around in the 70s and early 80s. I think it'll still be a significant factor, but maybe not as much as it is right now. We're seeing some signs on the kind of starting signs on the what's the word I'm looking for, like retail and vendor side, where they've kind of overstocked on supplies in some cases, and that could help kind of drive down costs. And maybe that'll be the tip of the spear, and also the same thing on the home price side, where the for sale market's starting to slow down a little bit. So maybe these are early signs that we're going to see overall inflation start to cool off a little bit. I certainly hope so. And then in terms of as it relates to cap rates, as I'm sure this is a very controversial topic. What is really the relationship between cap rates and interest rates? And it's not as correlated as I think people necessarily want to think. It really comes down, to the desirability of the asset class and the alternative options. And I think what we're seeing right now is I think we're still early on in this, obviously, but a lot of what's sold so far this year were deals that were already kind of planned to happen prior to the recent run up in rates. And so there's been some, revising of terms and whatnot. But I think what we're really going to see the second half of the year is sort of the fallout of all this, which is this dance between sellers and buyers, which is the sellers, unless you have to sell, you don't really want to sell at a reduced price. And the buyers, of course, are more mindful about, they don't want to buy at the top of the market. And they also are, mindful about the spreads, and they need to see a higher cap rate in an inflationary environment. And so, my take on this at the end of the day is that, rates will go up a little, cap rates will have to go up a little bit. Mm-hmm. I don't think and I think we probably are already in some cases, but I don't think they're going to go up as much as people might think. I certainly don't think they're going to go up as much as interest rates have gone up. Right. And that's just because, again, when you look at the environment and, investments are all relative, and returns are relative. And everything right now is going to be a kind of a compressed yield in an inflationary environment. Sitting on cash is losing money in an inflationary environment. And you look at your options, and obviously I'm biased, this is what I do, but I don't see a lot of options that in terms of mainstream investments that are better than rental housing, because of all things we've talked about in terms of rent growth and the ability to pass on costs, affordability, all this kind of stuff, the undersupply of housing. I mean, all of these things. And so I think at the end of the day is cap rates will go up, but not that much, just because, apartments and single family rentals are going to remain attractive. And frankly, I think they've kind of risen from an alternative asset class to a primary asset class where investors are more willing to accept, compressed yield, just because, frankly, it's a lower risk option where you still are going to, guaranteed to have some cash flow.
Yeah, absolutely. Those are great points across the board. What we've seen at Capstone companies, obviously we're dealing with hundreds of trades. We've definitely seen a lot of repricing, retrades across the market. And there's that pain point of, hey, my neighbor sold his property at the end of February and look what he got per door. And it's like, well, the whole world changed in March and now it's July and we're trying to close your deal. So there's a lot of that market adjustment. But to your point, we are still seeing tons of capital across, in particular, the Sun Belt, but the Midwest and West Coast markets as well, flowing into multifamily. I do think it's a preferred asset class. We're seeing groups take lower returns on the equity and on the debt side just to get deals done, quite frankly. Because to your point, where are you going to put your money? The stock market had its worst 6 months since 1970. I mean, that's not a great alternative right now for a lot of people to start out the year. So I agree with you there, Jay.
Yeah. And I sympathize your position too, because, as a I think the challenge is kind of anytime there's a transition in the market, there's this dance between sellers and buyers. And I don't think that we've kind of settled on a new kind of normal yet. And I think because of that, we'll probably see a slowdown in kind of total, which I didn't really expect to see originally, but I think it's become clear that we are. We're just going to see a slowdown in overall deal flow as the market tries to kind of find that new normal and what cap rates should be and what sellers are willing to sell for and buyers are willing to buy at.
Yep, absolutely. What do you think in terms of new construction delivery, and what markets are absorbing the most units right now? I like to watch that.
Yeah. So, kind of good news, bad news here is that, I think mostly good news is that there's a lot of supply. Apartments, as you know, we were building more even prior to 2020, brief pause and starts as we kind of try to wait out the pandemic and kind of see what would happen. And then a huge spurt in starts. And so, now we're going to see a very large wave of completions, into 2024, if not longer. So, we're talking about, the construction numbers now are the biggest numbers in 40 years, which is, just like inflation. We're seeing the biggest numbers in 40 years. So in the long run, I think it's a really good thing. I think it's healthy. I think that we need that supply. It expands, the sector. It continues to make the sector more liquid, and also it provides necessary housing to people. On the downside, I do think, I don't like the word oversupply. I don't think we are going to be in an oversupply situation. Oversupply is a very kind of loaded word that tends to suggest that there's more supply than demand at a macro level. I think rather what we see is that there's probably going to be pockets where there's more supply in a short-term period than there's demand in that particular period. It takes demand a little bit of time to catch up to it. And so maybe you call it oversupply. I just think oversupply is too harsh of a word for that. The market tends to correct itself by pulling back on supply in those situations. And so a couple of thoughts here real quick is I think that I'm still most concerned about kind of urban Class A plus supply. I think that, particularly in the Sun, I'm a big Sunbelt advocate, as everybody knows who watches my stuff, but when you have a lot of these downtowns across the Sunbelt where, we built, thousands or tens of thousands of units, and everybody's kind of built, nice, cool, unique stuff, but we sort of commoditized nice, cool, unique stuff. And it's all competing for the same renter and upper income profile. I think we're going to see some short-term challenges in those spots, realistically. And I'll be a little obviously heightened if we see a real economic slowdown. Conversely, we're still really bullish on the suburban stuff. It's really hard to build in good suburbs, there's suburbs are still viewed by a lot of investors as like sprawl and risk, but a lot of that's misguided. Most suburban construction is more infill, and I think the mindset of a lot of investors are thinking about like the desert way out of Phoenix somewhere where someone built 10,000 houses and 2,000 apartments in a Walmart, and they all did poorly for a while. And that's just not the reality of what most of this is. So in terms of where we see the absorption right now, there's still, there's demand in everything right now. Housing is just flying off, everywhere. Everything that's built gets leased up. But in general, the demand has kept pace with the supply so far. And so, we still see, because a lot of the supply has been Sunbelt oriented, a lot of supply in the Carolinas and in Texas, Nashville, Denver, New York, obviously lately has seen a big spurt of absorption. And so it's generally, demand is going where the supply is going. And I think that's a good lesson is, generally there's demand for housing pretty much everywhere if we build it.
Right. If you build it, they will come. There you go. Are there any markets that you think are undersupplied that developers should keep their eyes on in particular?
Yeah, no, I don't think there's any secrets at the market level anymore. I mentioned, I do think there's appetite and potential to build in some of these so-called Zoom towns we mentioned earlier, particularly those in the Southeast and in the mountain areas I mentioned earlier. So, those are some of the tertiary markets in Florida and the Carolinas. Even places like Northwest Arkansas and I mentioned like places like Provo, et cetera, or Midwest one like Grand Rapids is a good market. But, there's still supply in those spots. I wouldn't say that anything's under the radar anymore. I think I think it's more within markets. I think that there's still opportunity in the suburban areas, particularly, middle upper income, more desirable suburbs that are hard to get into. I think there's opportunity in some of these places to be building, given the cost of construction and whatnot, you have to build A+ type stuff. So getting these high income suburbs that are frankly hard to get into and those sites are more limited, those are the places that I would still be targeting, just because those sites again are limited. There's natural barriers to supply. Funny, people talk about barriers to entry. Like it's really, some of these high income suburbs are hardest places to get into these days. I mean, the downtowns have proven to not really have a barrier to entry because cities are happy to build downtown. They don't like you building in the suburbs. And so if you get into those spots, the demand is already there, and your supply is going to be constrained.
Yeah, absolutely. Very bullish on the suburbs as well. Outside the Raleigh market where I'm at, Cary, North Carolina, or Wake Forest, the deals that have gotten in there have just absolutely crushed it and done fantastic, much higher than average income, very desirable school systems, good sports teams, everything, and great employment nodes that are kind of little micro nodes. Used to be everybody commute to Raleigh or to Research Triangle Park, and now we're starting to see, just like I think across America, Jay, like each little town is becoming its own microcosm a little bit in terms of employment. We're seeing employers sublease small spaces, like old bank buildings, for example, I've seen, just to have some place to house employees locally so they can live where they want. So that's a big shift too. Yeah,
those are all great places you mentioned. I'll mention another one in the Carolinas, in Charlotte. We've seen a lot of construction, obviously uptown and South End. We've seen a lot in the kind of that I would call cheaper areas like the North Charlotte area and Southwest. But you look at Charlotte's a good example of a market where, like South Charlotte, Myers Park, South Charlotte, Ballantyne area. These were kind of the historical, kind of demographic strength in terms of incomes. And it's very hard to get sites. They're very hard to build there. It's very expensive. And there's very limited supply in those areas. But if you get into spots like that and just find ways to make it work, like those deals are going to do really, really well in the long term. And I'm just picking on Charlotte as one example, but you could find places like that all across the country that are tough to do, but I think are worthwhile.
No, that's great. Actually, our corporate headquarters is in the South End submarket of Charlotte, which is right now the hottest multifamily submarket in Charlotte. The rent's $3 a square foot. I mean, I'm there a couple times a month staying overnight, and just walk down the road and you see a dozen projects going up, Jay.
Yeah.
Red hot right now, to your point. So
it's been that way for like a decade. It just keeps going. So
it's very interesting. That's great. Well, I always appreciate your insights. You added a ton of value. Would you like to give us an update on what you're working on these days at RealPage and what's going on in your world?
Well, sure. So, so I think as many of you probably know, RealPage is a global provider of software to the real estate industry, primarily rental housing. And so, we're, a lot of what we're thinking about right now is just our industry is seeing so much, I think, growing sophistication in terms of, technologies and what renters really want, more, kind of the Amazonification of the renter experience, this instant gratification, 24/7 service. And so we're focused on a lot of those kind of things is kind of these simplified experiences and instant gratification for the residents. And for me, on the data side, it's been great because, we're seeing, through our tools, like, I oftentimes, tell people, I feel like, if people know ADP, the payroll company, they got all this great data through the fact that they process payrolls. We're processing, everything from, rent rolls and rent payments and facilities requests and communication between residents and property management teams, leasing leads, all this kind of stuff. And so we get all this great data. And so to answer your question, really, I mean, most of what I do right now, I'm just, other than having conversations like this, is just looking for these inflection points in the market, because obviously the world's changing fast right now. And it's been, kind of like a kid in the candy store, haven't had this much data to be able to look at from these different tools.
Okay. No paralysis by overanalysis, I hope.
I hope not.
That's awesome. Well, once again, Jay, thank you. It's been a pleasure having you in the Multifamily Method podcast, and hopefully we can get you on a future episode someday.
I'd love that. Thank you so much for having me.
Have a great one. Take care.
Thank you for listening to Multifamily Method. If you enjoyed today's episode, please give us a rating and a review on Apple Podcasts. It helps our podcast get discovered by other savvy investors like yourself. Subscribe to Multifamily Method for free on your podcast platform of choice. Find out more about Capstone Companies at capstone-companies.com. Multifamily Method is executive produced by Capstone Companies. Audio production for the podcast provided by Andy Go of Gojo Studios, and video production by Yash Mistry of Mystery Projects.